would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Welcome back from another weekend, folks. I hope everything has gone well for you and that you had a great weekend. My oldest son had his birthday this weekend, so that was fun. He'll be off to college this year. Very bizarre. Not really a real estate thing, but definitely a life thing, right? One of the reasons, you try to succeed and you try to achieve things and you try to reach for certain goals is because you want to do it for the folks in your life that matter most to you. My children absolutely fill that role for me. So everything I do, I try to make it feed just a growing, successful vibe for the whole family. Whatever motivates you, I hope you're making headway and that you're reaching good places. We've got a variety of different things to talk about today. As I have harped on endlessly, it's all about the debt, stupid. I think that the profile of debt that's held by the average person is a big thing to keep track of. If you're an investor, if you're someone who's investing in anything, whether you're someone who invests in stocks or someone who invests in bonds or options or real estate or anything else, I think being plugged into things that are happening right now as it relates to how debt is settling into the general population is a key thing for you to understand in terms of anticipating what's coming. And for the most part, it hasn't been great news. Now, we're going to talk about a variety of pieces of information today. Some of it is very real estate specific, and some of it's more economy in general applicable. But I think says a lot about where things are going, or at least gives hints to where things are going. And the only question in my mind now, I feel confident enough in anticipating not great things that I'm actually doing things in my own personal life that reflect that. As I've mentioned, I'm trying to sell my personal residence, which I will then not purchase, most likely, unless I can find some just ridiculously awesome deal. And it would have to be ridiculous and awesome. I will not be purchasing another home where I currently live. I'll rent a home, and I will take the money I have and invest it in other markets that make more sense. Markets we talk about here on this show all the time. Places that get better rates of return. Places that have lower barriers to entry. I would much rather have my money in 4 different homes than in one super expensive home in terms of an investment. Just because it's a real estate person's way of diversifying. And I'm pretty sure I'm not even going to buy in the same markets. I've talked a lot about Tennessee. I like Memphis. I like Chattanooga. I'm slowly being convinced by folks that we get on the show for interviews who are from Tennessee to look into Knoxville. I'll have to go get some ground truth, so that would mean a trip to Tennessee. And I know I say that right now, and I've done this twice before where I have said these are great places to invest. I've talked about going and visiting those markets, and both times I missed the boat in that I was absolutely right. They did end up being amazing markets, but I should have gone and done the stuff when I said I was going to do it, instead of letting myself get bogged down in some of the minutia of life going on right here at home, which maybe that's not a huge sin. I think that happens to all of us. But I think something I need to come to grips with, and maybe you do too, is to not let that minutia stop you. No matter how important you think doing X, Y, and Z here at home is, or letting something stop you from taking a next step in an investment, no matter how important you think that is, come up with a plan to not let it stop you. So something I'm toying with, and of course, I'll take you right along on the ride with me. One other thing that's probably going to be changing here, not changing. For those of you who consume the podcast, it's not going to change. The only thing that might change is as the podcast grows, as I get more support for the show and we start to see it be an attractive avenue for sponsors and whatnot, and it starts paying for itself and I'm able to devote more time to the show, you're going to get more diverse levels of content. You're going to get interviews from people who are more interesting for folks that are in the real estate investment world. Although, you know what? We have hit some amazing home runs with the interviewers, the folks that we've had on the show to be interviewed. I really think we've had some amazing stuff, starting right out of the gate with Francis Greenberger, who was awesome. Francis Greenberger is definitely a great guy to read his book. I forget what it's called, the something game. I wish I could remember it, but gave away some copies of that back when the interview happened. If you haven't checked his stuff out, just Google Francis Greenberger. Absolutely worth your time. Absolutely. In fact, you know what? Maybe I'll put a link to audible.com for you to get a hold of his book. Remember, Audible is one of our sponsors. If you want to participate in Audible, get yourself a free book and a 30-day free membership in Audible, right along with a free book. We can do that. Just click the link at the website at therebelbroker.com. There's a link in every show's show notes for you to go to Audible and check that out. So make sure to take a minute out and take advantage of that. Okay. And of course, the best way to reach out to me is through the website. You can do that at therebelbroker.com. Click on the contact link in the menu bar. And from there, you can send along any ideas, suggestions, observations, or questions that you might have. So feel free to do that. And I guess finally, for those of you who've been listeners for a super long time, you might have noticed we had a few reruns last week relating to the show where there were just things are really coming to a head in a lot of different things in my life. So I apologize that you've sort of, in addition to me trying to share with you what's going on a kind of a weekly or every other week basis, what's going on with my own personal efforts relating to selling my property, other things have kind of come up that have complicated things. So I apologize for those moments, but hopefully once everything is settled, we'll be able to really get back into an awesome, consistent stream of new content for everybody. And the other part is there are so many new folks. Thanks to all of you who've been listening to and supporting the show. Word's getting out. We're getting more folks listening. And when I do a rerun of a show, I don't do shows that talk about the news of the day. It's going to be topics that stand independent of what interest rates have done over the last week or what the most current in real estate news is. So it's going to be things like interviews. It's going to be things that are more talking about a process of how to achieve something versus specific news-related stuff. So I appreciate your patience when those moments come along. Of course, there's also the times when a guy's just got to take a vacation for a few days. But I promise we'll always keep the content pertinent, meaning if I have a show that talks about the news from 2015, I'm not going to be rerunning that show. So thanks to all of you who've been continuing to make the show such a success. And I look forward to moving forward with you as a member of the audience to make it just that much better. All right, so let's go ahead and jump in. We've got a few interesting topics here. We've got, and the thing that's worrying to me is some of these are kind of really at the heart of just bad things, particularly things. And when I say at the heart of bad things, I realize that's a very generic topic, but at the core of bad economic things. So not just bad real estate things or bad stock market things, just bad things that will be so far-reaching they will hit everybody, no matter what you're in. And the first one that jumps out at me is data that shows that Social Security will be paying out more than it receives in just 5 years. Now, one thing everyone needs to remember. Now, why is this a big deal, right? Because it's about indebtedness. Remember, I keep talking about keep your eye on indebtedness. And granted, this is government level indebtedness. Social Security money that gets taken out of your checks doesn't go into a bank account. It gets immediately spent. It goes into the general fund. So it's not protected, right? It's not like a pension. In fact, the reason why this is also interesting is I've had several of you reach out to me and go, well, hey, that pension stuff sounds just like Social Security. No, it's worse than Social Security. At least with pensions, money that goes into the pension fund is supposed to then get invested. Well, that doesn't happen with Social Security. With Social Security, all that money that you see sucked out of your paycheck on a regular basis goes into the general fund and Congress spends it. It doesn't go into an investment. It doesn't go into something that will preserve its value in any way whatsoever. It is entirely linked only to the faith and credit of the United States of America. And that is it. So when you say things like Social Security will be paying out more than it receives in just 5 years, that should scare you. There is nothing linked to Social Security to make it viable other than the fact that more people pay into it than receive it. It's absolutely the Ponziest of Ponzi schemes. If you read the definition of what a Ponzi scheme actually is, that's Social Security. Even the pension plans, which is also a Ponzi scheme, is at least slightly less Ponzi-ish. But Social Security is really up there at the top. Now, standards have changed, lifestyles have changed, and things that has really made Social Security relatively unworkable in terms of being able to be sustained. According to the Social Security Board of Trustees, the Old Age and Survivors Insurance and Disability Insurance Trust Fund will be depleted in 2034. When this happens, only 77% of benefits will be payable. That estimate is no change from last year's estimate. In addition, the Disability Insurance Trust Fund will be depleted in 2028, which is an improvement from last year's estimate of 2023. Once that fund is depleted, 93% of benefits will be paid. Right now, Social Security continues to take in through revenue more than it pays through benefits, which is expected to continue until 2022. Once Social Security begins to pay out more than it takes in, it will be forced to liquidate the assets held by the trust fund. So there are apparently some funds held in trust. My understanding was that money just becomes available to the government. In fact, my understanding is that the quote-unquote trust fund is actually just loaded with IOUs. Now, someone else can correct me on this one, but that was my understanding, that there's no actual money. It is theoretical money. In 2016, Social Security generated $957 billion in income and only paid out $922 billion, including $911 billion to benefits to 61 million beneficiaries. And this is pretty much on target, right? I mean, it's actually coming early. I seem to remember conversations in the 80s about Social Security being insolvent by the year 2030 at the outset, and now we're coming in at about 8 years earlier. So this is the reason I bring this up, and I don't. It's not because this is it. This is the thing that's going to do everything. It is simply one more stressor. And if you've been listening to the show even for just a few weeks, you know that we've listed off a ton of financial stressors, and any one of these things could kick off sort of a domino effect of other things that seep into everything else, right? Imagine what happens when bad things like this occur. And so the window ends up smelling a lot like sometime between 2019 and 2023 in terms of things going really bad. Now, I've already said in 10 years, I expect people to look back and say, October of 2017 was the beginning. And not a big step. I don't expect them to say that was it when everything dumped. I don't think that somewhere in October we wake up one morning and find everything has taken a dump. I think what we find is that the stock market loses value, and if it stays at that point, if it adjusts downward. And I don't know anyone who doesn't think that the market is not overvalued. Everyone I've listened to, no matter what station or what outlet, whether it's Bloomberg, whether it's CNN or Fox or MSNBC, when you talk to financial people or you hear financial people talk, no one thinks the stock market is properly valuated. And when you read into the details of why and how things are calculated, it's a mystery as to why things are valued so artificially high. And it's a little bit less of a mystery when you realize one reason why the Fed's done what it has done is to prop up the stock market. If interest rates go up, then the stock market goes down. So, or at least if the Fed rate goes up. So there's that. And that's one little tidbit of information I think is super important. One other, we've got about 2 or 3 more stories I want to hit. The next one we're going to hit before we take a quick break is interesting. And I'm trying to figure out what the angle is on this one in terms of what kind of an effect does it have on the rest of us. The headline is thousands of student loans worth billions are getting erased on a technicality. Now, this comes to us from Zero Hedge, but it's obviously a story that's some of their commentary on another story out there. Let me just give you the sort of the big picture on it. The National Collegiate Funding NCF, is an umbrella name for 15 trusts that collectively hold 800,000 private student loans, totaling some $12 billion in outstanding obligations. Now, understand what all that means. Those are all trusts, right? Now, what's also interesting is that my understanding of the way a lot of these student loans are managed is, U.S. taxpayers, they're insured, they're federally insured. So if there's problems with these, it costs money to the government, which means it costs taxpayers, right? So that feeds into our debt question. The other thing is, my understanding is that these are also instruments that you can invest in the stock market. Okay? So keep those two things in mind as we finish this. It goes on to state, the only problem is that roughly $5 billion worth of those loans, or over 40%, are currently in default. Ordinarily, when a student defaults on their loan, NCF simply files a lawsuit in local or state court as a means for negotiating a settlement or payment plan with the borrower. However, NCF is increasingly finding out that much like subprime mortgage debacle from 10 years ago, student lending institutions apparently had a really hard time keeping track of paperwork over the years and or processed deeply flawed contracts with incomplete ownership records and mass-produced documentation. So as they point out, they're originated by these large commercial banks before being sold to numerous other financial institutions and ultimately ending up in a securitization owned by some unsuspecting European pension funds. So there you go. They're securitized. We've talked about those. That means those are things that people can invest in the stock market. And while pooling these student loans in such a complicated way into securitizations apparently magically eradicates all default risk associated with the underlying loans, but it makes it impossible for these folks to prove ownership. Now, I'm going to go ahead on Pinterest and include kind of an interesting graphic about this. But what this basically means is that the way these folks are going to be able to just kiss off thousands of student loans is these organizations are unable to prove that they own the loan. Just like happened with so many mortgages, right? With the robo-signing and all these other things, as things get securitized, put into a security, and they get transferred. Remember, the days when people would actually have to physically go and sign for something to create these transfers just weren't happening with the mortgages. It also isn't happening with student loans. And you know what? In retrospect, man, would it have made sense for someone to say, well, you know what? This was a really bad thing in real estate. Maybe we need to check the same thing with student loans and with car loans and with all these other kinds of loans that get turned into securitized instruments. But the long and the short of it is, tons of these things are going to end up not even being collected. They're just going to disappear. They're going to go poof. As a result, thousands of students are finding they can easily get their student loans expunged on this technicality. A case in point here is Samantha Watson, a 33-year-old graduate of Lehman College in New York, who fell behind on her student loans primarily because she didn't really understand about things like interest rates. Luckily, she doesn't need to invest the time to learn how to multiply fractions, because when NCF failed to provide adequate ownership records, some $31,000 worth of her student debt was magically erased. Her experience is hardly unique. One defense attorney in Iowa told the New York Times that she represented some 30 borrowers in cases against NCF and only lost one of them. So let's take a quick break right here. And when we come back, we're going to talk about, is this a good thing or a bad thing? Because this is another thing that could potentially cause much bigger problems than you might think. So don't go away. We'll be right back after this. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner, broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. So we've been talking about thousands of student loans that are likely to get just blown away on a technicality for the exact same reasons that we saw mortgages having problems back in 2006, 2007, 2008, where because these things have been securitized and changed hands so many times that no one could prove they owned it. Now, I find that interesting. I found that argument interesting back in the olden days, simply because at some point you would be able to trace ownership of this loan to someone, right? Even if you can only trace it back to the original underwriter, if you can only trace it that far, then it seems to me you go to that person and say, hey, you know what? You're as far as we can go in terms of tracing ownership, so you own it. But that never seemed to occur to anyone, which I find interesting. It seems to me that no debt should simply just go poof unless the last person who can be shown to have had direct ownership of it says it goes poof. So this idea that you simply can't prove that the current claimant holds it, the idea should be you go back far enough that you find the person who does hold it. And if everyone wants to operate on the up and up, if they've got records on who they sold it to, well, then do the proper paperwork to indicate the transfer to that person. And then if that person knows who, you know what I mean? It seems to me that a proper level of due diligence on these kinds of debts would reveal this stuff. So it all kind of stinks a little bit to me. But there's that, right? So, but here's the thing. Who does this help and who does this hurt? So obviously it helps the person who took out the loan, but it also hurts the person who took out the loan. And granted, we're going to talk a material failure for the person, and we're going to talk a principal failure. Or the success is financial, right? If obviously now I don't owe $31,000, I am going to go out and I'm going to celebrate with probably the most expensive bottle of champagne that you can get. So great, right? That's a short-term thing. But the negative thing is that person has learned a lesson. The lesson that they've learned is you can dodge debt. There's things you can get away with and never pay back. That is not an attitude that people should have. When you assume a debt, there should be an amount that you have to pay back. I mean, you should be expected to live up to your contractual agreements, because no matter what else you can say, you can go back to that original document and say, you signed this saying that you would pay back this money under these terms. End of story. That's it. It seems to me there should only be two ways that ends up, with either that indebtedness being owed to the last person that you can prove, or last entity that you can prove held legal ownership of that debt, or it goes to the government and the government owns it. There's no reason for it to disappear, because remember who's on the hook. Now so that's the benefit and the not so great benefit. I think it teaches a bad thing that might bleed into other financial things that they have going on in their life, and make them, frankly, a less responsible borrower, right? So, you know, on the one side, there's the tangible, yay, I'm not paying back $30,000. And then on the other hand, there's the principled, and now I'm learning a lesson that will make me be a less reliable borrower, right? Which hurts the rest of us when they're allowed to borrow, because you know they'll be allowed to borrow. They'll just be a higher risk person, but we've already shown that we're willing to embrace that higher risk. All right. So now what about everybody else involved? We already know that these types of loans get securitized, which means, and then and as soon as you say that word, all the other things we've talked about that could push our real estate market deeper into an abyss than it went last time starts to happen. Well, okay, it's securitized. That means that people have invested in it. For my money, if I'm a guy out there who's managing investments for a pension fund or something else, and I'm looking for stuff that's the most reliable, it seems to me that what I invest in are things like this, right? I mean, investing in student loans seems like a not so risky thing, right? So there's that. And if you have enough pensions involved in that, it simply makes the position of pensions that much more tenuous, which means that the process of pensions going completely bankrupt is accelerated because they don't have the amount of money they thought they did anymore, because these investments are now getting sucked dry because of thousands of people who suddenly no longer owe money that they used to own to a thing that was that was involved in this securitized thing that folks were investing in. But then there's also the other angle. And what is that other angle? Well, this money isn't just going to disappear. These loans are federally insured and backed, right? The whole student loan thing is a federally supported process. And you can bet that somebody somewhere is going to start talking about reimbursing these banks, these institutions that underwrote these loans, or that claim to have the most. Somehow this is going to end up on the taxpayer's back, is what I'm saying, since these are federally insured. Now, I guess you could make the same argument. Well, then, since no one can prove that they own it, the government doesn't owe anybody any money. But I can't remember the last time. See, that argument works apparently when you are a borrower and you don't want to pay. I have never seen that work when it's the government owing or not owing the bank money. For whatever reason, and we can have lots of discussions about that. Maybe it's because you're a relative of Maxine Waters and you are invested in a specific bank that's very heavy into student lending. We find historically, and that's a real thing, by the way, that under those circumstances, those banks get bailouts when bad things like this happen. So my guess is that the federal government steps in. And remember we've talked about what happens when the federal government steps in. We talked about it in the last show. To print up the money that's going to reimburse people for this loss from student loans. And they will just print it up. So there goes more inflation. Less inflation, right? Because remember, we talked about the velocity of money that gets printed, and this won't have it. Because this isn't going to go into the hands of individuals. It's going to the hands of banks. But it still is indebtedness that affects you, because while it won't be as bad as it could be, it'll still cause minor inflation. So it's not a good thing. In general, in a bigger case sort of way, this is not a good thing. And the idea that that there is a benefit here that is broader than just the individuals who no longer have to pay this amount is absolutely unfounded. There are some places where I'm reading that they think that's the case. I don't believe that to be true. I think that it actually represents far more negatives than it does positives. Okay, now, sort of in the same vein, a little bit more back into the debt discussion, is more discussions about debt bubbles. And this one's a little bit concerning. The credit cycle, according to the folks at Zero Hedge, is turning for the worse. Now, they're extrapolating this from data from Federal Reserve System. So data reported by them. This isn't data that's being made up by them. But delinquency rates are creeping up in the consumer loan and commercial industrial loan space. So the consumer and corporate sectors of the economy are beginning to run out of steam. This is not a good thing. If we take a look at the delinquency rate on commercial and industrial loans, all commercial banks, what we see is a much bigger jump in that space. And that's concerning. These are things that this particular one, the delinquency rate for commercial and industrial loans, is usually more of a leading indicator. When you start to see delinquency go up as much as it has over the last year, it was at about it was actually less than 1%. It looks like it was about 0.5%, and it has jumped up to over 1.5%. And that's concerning. That is a dramatic jump. If we look at the numbers for delinquency rates on consumer loans with all commercial banks, we're seeing it's gone from about 2% up to about 2.25%. But what concerns me about the delinquency rate on commercial and industrial loans is that's more of a bigger business thing. When you start to see that kind of stuff happening, that kind of default level happening, I get worried about jobs. And remember, one of the things we've always talked about, for those of you who've been listening for a long time, when we were talking about what will fix the real estate world, the first thing was employment. If you get good jobs where you can afford to purchase a home, that's what fixes real estate in terms of facilitating buyers. Now, of course, the more recent problem has been less about facilitating buyers and more about facilitating construction. But overall, if you have a robust employment situation with folks making the kind of money, the kinds of careers are being provided where folks can jump in and make these purchases happen, I think everything benefits. The economy in general, I think building benefits. I think buyers benefit. I think in overall, we're in a much better place in real estate when the business world is doing well and hiring people. And what we're seeing is that this is the kind of indicator where that may take a hit. Then according to their overall conclusions here, the economy is showing signs of stalling. So banks are pulling the plug. The last time both of these issues came to rise, and again, kind of gives us another feeling like deja vu, was in 2007 as the last major credit cycle turned. We all remember what happened next, particularly given that stocks were in a massive bubble at the time, just like today. So just more concern there. I think these are all elements that show what we've talked about here is that this isn't a situation where we need to be staring at one specific thing and pray nothing goes wrong with it. This is a situation where we've got how many have we talked about here? A dozen different angles of attack on the economy, where if any of them start to have a problem, it feeds all these other problems. It sort of trickles down into all these other areas that then drag the economy in general down with it. And right along with that, the housing market. It's going to be very interesting to see how this goes. What's particularly interesting is the very low inventory. Construction was the one big difference between now and last time was that construction was happening so rapidly. There were so many new homes being built that it was really sort of at least keeping up with that demand. Now, demand isn't nearly where it was then. In fact, the only real reason why the market feels so robust right now has been the inventory issue. What happens if that dries up? What happens if folks have to retreat because the job market softens, because pension markets start to have a problem, because investments start softening because of what's going on with different loans that are going in default or different securitized things that folks were invested in that are causing their financial future to look less secure? Those are all things we've covered over and over here that kind of lay some scary groundwork for where we might expect the markets to go. Now, because I'd much rather end on a happy note, we can cover two things. One, the house builders' attitude measurement went down a little bit, but what's interesting is permits rebounded in June despite that lack of confidence. There was a drop in May in building permits, but building permits rebounded in June plus 7.4% month over month, the most since November of 2015. So I actually think that's pretty good. Permits, as you know, is a leading indicator, right? It's one of the first things that you have to do as a builder. It's not one of the first things, as you know from the conversation we had with an interviewed person just a couple of weeks ago. You know, finding that lot, getting all those things set, working through the system there is clearly high on the list. But one of the big things is getting those permits done, because permits have to be acted on within a certain period of time. So it indicates a level of commitment. We've seen a very big jump. And as they mentioned in this, it hasn't been since 2015 that we've seen this level of increase. So it's a good thing. I think that's amazing. I think that's fantastic. Do I think it's enough? No, I think we would need to see growth like that on a continuing basis. And we'll have to see what happens in the coming months. But I think it's a good thing that we're going to see some of these going up. Both single and multifamily jumped. What's interesting here is that single family is now above multifamily in terms of permits. Multifamily permits has been down a little bit more this month after really ruling the roost in terms of permits going all the way back to 2011, 2012 timeframe. But it looks like we're starting to see a little bit more robustness. What's really interesting is there's actually been a steady decline in multifamily permits over the last year and a half or so, even though that's also the same time period when it's been clearly the push of really the overall real estate world to do the multifamily thing. All the construction I've been seeing have been apartments. And what's particularly interesting is while we have seen declines over the last year and a half in multifamily, and we've seen upticks in single-family residential, that uptick in single-family residential since mid-2016 has been primarily in the higher-end market. And despite these upticks, downticks in multifamily, apartments, condos, townhomes, those types of things, and the very, very small uptick in single-family residential. We haven't seen demand in that same time frame grow at the rates that we would expect. So this almost kind of indicates to me, from my ground truth in Morgan Hill, that I'm seeing fewer buyers accompanied with fewer properties on the market. So, but it still feels like there's tons of activity. You see what I mean? In other words, we've had enough stagnation or decline in the inventory side that any declines in the number of buyers really has still been overshadowed by that lack of inventory. So it still feels like a feeding frenzy, and it is. People are acting like it's a frenzy, even though what's really bringing that on is this disparity between the inventory and the number of buyers. And so I'm not ascribing this to a ton of new buyers. I talked about how in the first quarter of this year, I saw a pretty good number of buyers coming out. I've actually seen fewer buyers at this time of the year than I saw the same time last year. I had way more stuff going on this time last year than I do this year. And I'm not just talking about active transactions. I'm talking about buyers actively searching, et cetera. So it's still this bizarre low inventory thing that's causing the primary problem. Let's see. Housing starts rose 8.3% month over month in June, the biggest jump since 2016. Both single and multifamily jumped. Let's see. I'll go ahead. I'll have a link to this story so you can check it out for yourself. But I really think these are some interesting indicators now. And as we get into a scenario where more properties are being built, and it's great to see permits are now overtaking multifamily, because I think that's a smart move. What we really want to see is what part of the marketplace do these fill? Now that we are seeing single-family residentials being built at a greater pace than multifamily, where are these? Are these the million-plus properties? Are the high-end properties? Are these middle-of-the-road properties? Because as I've mentioned on previous shows and what I'm seeing, because remember, I keep track of all the brand-new construction that comes online, I am still seeing stuff way above the average home price in most marketplaces coming on the market. And those that are at an average price are not an average property. They are a below-average property. There, for instance, some new condos just got built all close to the $800,000, $900,000 mark, that at that price point should be single-family residential 3-bedroom, 2-bath homes, but they're 2-bedroom, 1.5-bath condos bordering railroad tracks, for instance, as I think of a specific development here in Morgan Hill. So keep all of that stuff in mind. Check your local market. See what you're seeing happening in terms of trends locally. I'm still a huge fan of investing, but I want to stay away from these markets that are most likely to be impacted dramatically by some of these potential downturns that we've talked about. Think about areas that went through the last downturn with relatively little fluctuation. They are out there, but the best way to find that stuff out is to hook up with a real estate professional in those areas and take a look at that data going all the way back 10, 15 years to see what the trend was. You can still absolutely make great decisions. Just make them with the best information. And hopefully we've taken a step towards getting you there today. As always, my absolute number one goal is to leave you with far more value than you've had to invest in terms of time. I hope we've achieved that today. Thanks again for listening, everybody, and I'll talk to y'all next time.